Hey guys, RC Peck here with Fearless Wealth. We are taught to diversify. And the way we're taught to diversify is to take in information. And the way our brain takes in information, at least when it comes to investing, is we take the information in audibly, right? We hear words, and then these words create experiences in our body. They create sounds. Now, you may not hear the sounds because they're happening unconsciously. They create pictures. You may not see pictures because they happen unconsciously, and they create feelings in our bodies. And those feelings may be happening below the surface, so you don't fully feel them, but this is the way our brains are designed. And so we get these words like Europe's doing better, Germany's doing better in regards to COVID, the Netherlands is doing better. And so we think, okay, they're doing better, and better is better for investing, and we want better investments. So we better get our money. We got to put some over in Europe, right? We have to put some over in Asia. We have to put some fill in the blank. And you were taught to think this way. You did not come up on it on your own. Someone taught you to think this way, right? And it's not entirely your fault. So on the screen here is a price chart of the German stock market, the DAX composite, and it's a 4.5 year price chart. And when I look at this, I see, let's just call Germany a company. I see a company that hasn't quite figured out its product or its marketing or its profit margin or its fill in the blank, right? It hasn't quite figured it out. Now, this is an index, so there's no dividends reinvested. There's also no currency issues here because it's the index of Germany, so it's priced in euros and not dollars. But, we are taught get money over there. Get money over there because that's better. Now, I'm going to just jump to tracking ETF, the MSCI Eurozone ETF. And you look at this, and again, I see a company that hasn't quite figured things out. And I can then go VEU. VEU is the MS World, the All World ex US ETF. That means this is basically all the stock markets of the world except the US. And again, I see a company that hasn't quite figured things out. Now, we want things to make fair. We want things to be fair. We want things to make sense. That's how our brain works, right? We want certainty. This is why people often go 100% to cash when they're scared, because 100% cash is certain. But the problem is it really kills their performance because it's hard to stay in cash the right amount of time. And so I bring up these conversations, these ideas, because I believe these are the ideas that are hitting your brain right now, as in Europe starting to outperform. Okay, well, I'm not seeing it in the price charts. So maybe it's outperforming in words, or maybe it's outperforming in COVID deaths. And by the way, this is not political, okay? Because you're being given this information, you've been given these words, and you say, therefore, if the COVID crisis is better in X country, therefore I should put my money over there. But that's actually not true. And if you just were taught how to understand price charts, and by the way, me showing you price charts and having price charts, that's not teaching. This is, part of it's entertainment, part of it's infotainment, it's information. But real teaching is experientially getting trained, right? Rewiring your brain. So I don't want one to confuse what we do and what I do here. Now, this doesn't diminish what I'm doing because it's giving you an insight that you have to get trained on how to really understand what's going on with your mind and your body to make the choices you're making with your money. But this is VEU. This is the FTSE All World ex-US ETF. MS World, it's the same thing. And so I'm not seeing, the price charts aren't seeing this huge move over to international. And this kind of makes sense because why are you thinking based on countries? Now, I don't like questions necessarily that start with why, but think about this. Why do you care what country your money is in? Now, if you have money allocated to the international stock market, someone taught you to care that countries matter. And maybe let's think about this a little differently. Let's think more about what COVID has exposed. And to me, what it has exposed is the most profitable companies, the most profitable ideas don't have boundaries, right? Microsoft is being used all over the world. So is Amazon, so is Facebook, so is Google, so is Netflix. These may be based in the US, but it's not a US thing, right? It just happens to be that at least the US used to allow failure. The US used to allow bankruptcy. The US used to allow capitalism. Now, that's not really happening anymore, okay? But this country, I'm in the United States. I'm in the Seattle area. This country used to allow failure. And that is one of the core ideas of what I think why people come to the US, because we are allowed to fail here, right? Living in Silicon Valley for 19 years, if you don't live there, you don't get how much failure is happening in Silicon Valley. It is an incredible amount of failure. You only hear about the Googles and the Facebooks. Amazon was started in Seattle, so was Microsoft, but you don't hear about just how much failure is allowed to make this happen. So there is still a magic in the US that allows and creates companies like Peloton and Zoom and DocuSign and TeluDoc. I don't know if TeleDoc actually is based in the US, but these are core ideas. It's not just a US thing. Shopify, I'll just throw in Shopify's price chart. Here's Shopify's price chart right here. Probably one of the best stocks in the last 5 years, if not ever. This thing is just going straight up in a beautiful, that looks up and to the right to me. And so Shopify, I think, is in Toronto. I know it's based in Canada, at least I'm pretty sure. Um, but if you don't have a filter to counter and filter out all the junk noise and words that can hijack you, you may end up going to buy EWG, which is a tracking symbol for the German stock exchange. And you look at this, you go, well, first of all, you're not even taught to look at what you own. You're taught to think about it. I don't see anything that good going on here. If you look at where the price is right here, yes, it's back to its price at the beginning of 2020, but it's below its 2018 price by 14%. And if we were just to compare that to, even just compare that to the S&P 500, the price of the S&P 500 today to the high of 2018, which, by the way, the high of 2018 right here in the S&P is right here. Germany is 14% below. The US is 15% above. Now, I'm just going to keep jumping back and forth here. Germany is right, let's see, from the high this year, it's just about 2.3% below the high, where for the, actually, hold on. I keep saying high. I want to I want to say the start of the year. I don't know really where the start of the year is here. We'll go right about here. So from the start of the year, Germany's down about 1.3%, which, not that bad. The start of the year for the US, the S&P is up 1.2%. Now, this is not a US versus Germany thing. What this is if you're not trained, and by the way, if you haven't actually paid to get trained and you have an experiential experience where you go before training, after training, you have not gotten trained. And that might be one of the problems. But what's happening is your brain is not filtering out what matters most. And so here we have the S&P 500, which apparently is supposed to drop soon or collapse or something, but it doesn't, and it's not happening, right? Because if you're just left in a world of words, you create an internal world of angst and overwhelm and worry. I've been seeing a lot lately that apparently the US dollar is going to lose its reserve status. Now, I've been hearing this, I think, my entire life. I was born in 1971, by the way, the same year that the US probably really did lose its reserve status when the US dollar was taken off the gold standard. Still on the price on the screen here is the US dollar. And I'm going to just keep zooming out here because apparently the dollar is going to lose its reserve status. whatever that means. No one really knows what that means. What does it mean? Does it mean commodities are going to get exchanged in yuans or yens and euros? It's already happening, guys. Fiat currencies have been around a very long time. I don't think they're going away. By the way, this is not pro or anti gold. So here's a price chart of the US dollar going back 20 years. Actually, let's just go for it, guys. Let's just, I don't know how far, oh, I didn't want to do that. I didn't want to hit annotate. I want to go back 50 years. Okay, yeah, we get to 73, 1973. So this is just the US dollar priced against a basket of other fiat currencies. Okay, I think the euro was introduced where somewhere around 99 or 2000. All right, but this is, first of all, it's only 50 years and this is being priced against other fiat currencies. So saying the US dollar is going to lose its reserve status to what? The euro? Okay. So what? So now let's say the euro is the new reserve. By the way, the other side of this price chart is 56% euro anyway. So the euro is already the second biggest fiat currency on the planet. But who cares if it loses its reserve status? That's the first thing I think. Like, who taught you to care so much? And your answer might be, but RC, I have to care because I don't want to lose money. Well, then my suggestion is you just get trained to ask better questions like, does it matter if the dollar loses reserve status? Maybe I shouldn't be so attached to whether the dollar is or is not the reserve status. So let's just look up a couple things here. So I'm going to pull up a price chart of gold here. So here's gold going back to 1971 when the dollar was taken, when the dollar stopped getting backed by gold. And I'm just going to do a little simple visual math and say gold over that time period has gone up 51 times. Okay, that means it costs a lot more US dollars to buy gold. Gold in 1971 was $30, $35. Today it's $1,966, which, by the way, when priced in US dollars, is the highest gold has ever cost in dollars. The highest ever gold has ever cost in dollars. So the dollar's been losing its purchasing power since it was created 250 years ago. The dollar's been losing its purchasing power since 1971, right? It costs 51x more dollars to buy gold. And we could throw in, let's just throw in the S&P 500 index. How many more dollars does it cost? And this goes back to, let's say 1970. Today, it's going to cost the US dollar 35x, 35 times more dollars to buy the S&P 500. So it's lost it's lost its status. I just showed you the stock market and it costs 35 times, 35x more US dollars to buy the S&P 500 and it costs 51x more US dollars to buy gold. So this has been going on for a long time. Someone taught you to care, and I'm willing to bet it's someone who's selling maybe a gold newsletter or some sort of just buy my stock newsletter. And I can tell you it is affecting your life and your health and your relationships negatively. Okay, that's the reserve status. Reserve currency losing its status. So let's zoom in a little bit on gold because you know what? Gold is rocking and rolling lately. I almost said later. No, I keep hitting the wrong thing here. I don't want this. I just want to zoom in on this price chart. So here is the last 5 years of the US, of gold priced in US dollars. So its old daily closing price was right around 1900. Maybe it was 1901. Its highest intraday price ever was about 1921. $1,921 was the highest that it ever hit intraday. And the highest gold that ever closed at the end of the day was $1,901. And here gold this is after market on Thursday, July 30th. Gold's at $1,960. I'm going to round up $67 priced in US dollars. So I can tell you one thing about humans is that humans want to trade things, like, because that gives them the feeling of control, and the feeling of control gives them the feeling of certainty. By the way, this is why anger feels better, because it feels more powerful than, say, being kind to someone, right? Because being kind doesn't actually feel as powerful as if you get really enraged. And unfortunately, what's happening these days is everyone is getting so enraged over so many things, and that gives them a feeling of power and being in control, even though it's absolutely hurting their life. So this is gold right here, priced in weekly, meaning it's the closing price for gold weekly. Now, this week's not done yet, but I keep I keep hitting annotate. People are going to want to trade gold. People are going to want to trade a trend. This is just how it is. This is where I was going. And I think that's a mistake. What I train people to do is to identify the main stable parts, strong parts of the market. And once you've identified them, that's actually not the hard part. That's a very, I mean, I literally can train someone in probably 20 minutes to find the strongest parts of the market. That's not to diminish that step. You actually have to know that, okay? But that's not the key part. The key part is really understanding your inner game and the mindset of how do you stay in a move for the whole move. I can tell you it's not selling options against it or buying options or doing anything with options. I can also tell you it's not day trading it or any sort of trading. It's identifying it and really understanding internally how your brain is going to want to sabotage that position. Now, I do have to zoom out, and I want to zoom out to, let's just go 11 years. Let's see if I can get the old high in 2011. So here's the old high in 2011. This is weekly. So the weekly closing, the old weekly closing for gold was about 1888, and we are for sure above that. I can change how this price chart shows its closings, and we can see last week's closing right here. Actually, that's not true. Last week's closing, actually, because that's not where it closed. Last week's closing was the highest closing ever of gold, and this week it's even higher. So if it stays up here, if gold stays right about where it is, we're going to have another weekly high closing in a row. Okay, that's not the point of me showing this to you. There is always price volatility. When you own something that other people think is weird, like if you own gold or silver, and guys, I'm not saying you should or should not own this, okay? What I'm talking about right now is how bad it feels to own something that maybe isn't as socially acceptable to own. And gold isn't necessarily as well. Let me just start over. Gold's not like owning bonds. Owning gold is not like owning the S&P 500. But even if you just owned the S&P 500 and nothing else, you would be a pariah. You'd be considered to be doing something very dangerously because you only own one ticker symbol. So when you own something, the volatility of it immediately goes up. Okay. You don't imagine that, all right? But what happens is because you own it, it's this Jekyll Hyde thing, right? So you own it, and now you create this relationship with it, and every little 1% move, one or the other intraday, it creates a bigger experience in your body. And so you have the experience that it's actually more volatile when it's not, right? You can look at another price chart or another something, and if you don't own it, it's like, oh yeah, I saw it went down 4%. Oh yeah, I saw it went up 4%, right? Because you have no attachment or connection to it, right? And this makes sense because as soon as you own something, it does impact your life. And so gold is going to have more price volatility when you own it. Same thing with silver. Now, silver actually is more volatile than gold. And when prices of anything start to break through old ceilings, old points where the price came back. If you look at the screen, you can see between these two blue lines, Gold could not break and stay above $1,800. Failed here. Second failure, third failure, fourth failure, fifth failure. On the sixth time, it broke through. Now, we'll have to wait and see if it stays above, but this sixth time it has broken above and it has made new daily lifetime highs and new weekly lifetime highs. It'll be interesting if we just go to monthly, see what the highest monthly lifetime high. So the highest closing high was right there. And so this month's not over yet. We are darn close to this month being over. And then we will have a new monthly closing high for gold, as long as it doesn't, let's see, it would have to fall about 9% tomorrow on Friday to reverse this. But the old monthly closing high of gold priced in US dollars was 1826. I'm having to start to squint these days. It is going to be more volatile. And if you're not trained to understand how to manage positions, you are going to do things that hurt your money. This is just how the brain is designed. And so here we are in an interesting situation where the COVID thing has accelerated everything that has already been going on, meaning tech has been taking over for what, 25, 30 years? Right? I think the energy sector represents 2.6% of the US stock market, and the tech sector represents 26%. So that's a 10x difference. But that's not even true, because that 26% does not even include Google and Facebook, because Google and Facebook are not tech stocks. They're communication stocks. Netflix is not a tech stock. It's a communication stock. All right. When you look at Walmart, here's Walmart right here. Why do you think Walmart's going higher? Because they've finally adopted technology. They're finally starting to be able to figure out their online presence, the click and collect. That's a technology play. Walmart's not a tech stock. They sell stuff and groceries. Okay. Same things with, if I get the ticker symbol right, Kroger. Kroger, if it's going to break to new lifetime high, it's not because they're selling more Cheetos or Budweiser. It's because they figured out the technology part. Now, when I say this, guys, it doesn't mean technology is going to the moon. I'm still on a monthly price chart. Interesting. It's so nice just how nice it kind of smooths everything. I'll go back to daily here. Even though I'm looking at 11 years, I'm going to zoom in a little bit here. This is not to say, I want to be clear what I'm saying and not saying. I'm not saying tech is going to the moon and will never reverse itself. I will actually bring up NDX. NDX is the NASDAQ 100. So this is the index itself. It does not include dividends reinvested. I'm just going to go back 25 years. It's older than 25 years, but here's the NDX. And so interesting, no one ever thinks about this, but the NASDAQ 100 just broke out to new lifetime highs, depending on where you want to measure it, in 2016, 4 years ago. So I believe bull markets officially start when they break out to new lifetime highs and not when they bottom. And you can see that this bull market really started in 2016. Now, if you want to take this and divide it, which is fine, we can just divide it by the S&P 500. You can see there's a peak here of what, so now what we're looking at is the NASDAQ 100 priced in the S&P 500. And so we're right at that peak. So that peak is 3.36. And it hit that peak and it fell down to here, which, by the way, interesting how there's a lot of resistance here. This is a relative price chart. So just now, 2 decades later, the NASDAQ 100 has just gotten back to where it was relative to the S&P. It took 20 years. Now let's think about what's going on today. So today, these companies that are part of the NASDAQ 100, Microsoft, Amazon, Facebook, Google, Netflix, they have profits. They have real revenues. Apple really made $60 billion last quarter. They really made that last quarter. This is real money. This is real revenue. This is real profit. They did not have this back here. I'm not saying to the moon and trees grow to the heavens. I'm simply pointing out that we are taught to care about what we own. And my suggestion is you care how your portfolio is growing with what stability it has. And until you're trained to think that way, it doesn't really help all that much other than maybe I should do that. So we are in accelerated times. This is going to continue to go on. Doesn't mean we won't have corrections, but to put things in perspective, we did not have the type of revenue 20 years ago as we have today. And I don't think this is about Europe versus the US versus China. I think this is about companies who are able to make money even if you don't have to go see them. There's no sector called that. And the last I checked, there's not many countries on the planet that have these type of companies. China has a couple, Alibaba, JD. What else? Let's actually put up Alibaba. Um, so here's Alibaba right here. And oh, look, it's at new lifetime highs. I'm going to zoom here because this is crazy zoomed out. But I think what you're going to find is across the globe, the companies that don't need to see you in person are doing well, regardless of what country they are in. I don't know when this is going to reverse itself, but I believe you should channel Isaac Newton as much as you can. And what I mean by that is something in motion stays in motion until something of equal and opposite force pushes back against it. So, in order for the NASDAQ or any tech companies or whatever word you want to give them, companies that can grow their profit and viewership without having to see you in person, until that trend won't change until something of equal and opposite force pushes back against it. It will eventually happen. But again, the breakout in the sector called I don't need to see you to make money, that started in 2016. And this is, if I'm getting it right, the beginning of the 5th year of it. So, guys, I hope this helps you. If you have questions, concerns, or comments, leave the comments. I read all comments. And I did a video 2 videos ago that answered all those questions. So please, either if you are subscribed, go ahead, please subscribe because it makes a difference. Go ahead and leave a comment below. I get them all emailed to me and I read them all. Of course, be kind. I have zero interest in you dumping your rage on me or anyone, and I just won't tolerate it. And I don't think you should tolerate it either. So, guys, I hope that you like this. If there's concerns that come up, leave them. If things I've said to you spur questions, that's a good time right now to leave a comment and let me know what's going on, and I can get to those next week. I hope you guys have a great rest of your week, and thank you for being in my world. And again, my name is RC Peck, and this is Fearless Wealth. All right, guys, take care.